Hey everyone, and welcome to the Coso Capital Podcast, where we discuss wealth building, personal development, and we are real estate investors and lenders. And on this show, we share our experiences, what's going on in the market, books, inspiration, and so much more. Now, I am getting better from the flu, so please forgive me, but I wanted to record this episode so we can stay consistent. Today is February the 18th, and I'm Denny Troncoso, and I am your host. And the first thing I'd like to say is, how about them Eagles? It's Kansas City Chiefs fans. Uh, Sorry. I know that you wanted a three-peat. It didn't work out, but hey, that's part of the game. And good thing, Eagles got their championship. So exciting times there. Now, we're going to talk on this one. President's Day was yesterday. We're going to talk about some quick market updates. I'm not going to hit the market that much. There's not a lot going on right now. Stuff that may be happening, but nothing solid. But I'll talk about an interesting article on rentals and how things are shifting toward landlords. But that's also important for you as a renter to start thinking about home ownership. And then I'm going to talk about some asset management tips for rentals. We've just dealt with some stuff where we took over management once again, and I'll talk a little bit about that and some tips there, some things we found, and then share some books that I read in January. All right. Some quick market updates to quickly get started, and this is the U.S. housing market says it's anticipated improvements this spring with existing home sales that are expected to rise. Factors include mortgage rates stabilizing above 6%. So mortgage rates they've been moving around quite a bit. They've been around 7, then they dropped to like 6.5, depending if you're looking to buy. I've even seen some on the FHA side in the high fives, right? But they just been bumping around, right? So we expect them to stabilize, and also people to kind of get a little bit more comfortable where these are where the payments are, right? And not so much bouncing around. Investor sentiment, despite initial optimism for the stock market, is what we're talking about here. In early 2025, bullish views have moderated due to inflation concerns and geopolitical uncertainty. So that means geopolitical is all around the world, right? Ukraine war, geopolitical stuff that's happening with, let's say, Venezuela, things that are happening with China and Taiwan. Those are all geopolitical things, global. And there's uncertainties with that, which there mostly always are. But then also kind of people are getting used to the market. They're like, what's going on? What's going to happen with tariffs? Markets may be overpriced for the on average time. Like so, typically the S&P, the Standard and Poor's, is around 15 times earnings. So a company makes $1 million. They say, well, to buy that company, it's worth it makes $1 million, it's worth 15 million to buy it, right? Forward earnings. Well, right now the market's over that. I forget if it's like a 20 or something like that on average. And that kind of says, well, maybe it's overpriced. Maybe I don't need to invest that much in the stock market. Maybe I need to, keep some money in cash, invest in other things. So it's people are still bullish. Nobody knows exactly again, but this is just what's kind of the sentiment in the market. So people are being a little bit more cautious. And this was a good one because it actually came from Howard Marks. If you haven't heard of Howard Marks, he's a billionaire, founder of Oak Tree, I believe, Oak Tree Capital. And what they do, they invest in a lot of distressed debt. And he stated in one of his last podcasts that the market looks to be a bit overpriced, right? Not necessarily that it is, but it's starting to look that way, right? It's starting to sound that way. So keep your eye out there. If you're a long-term investor, nothing to worry about. Just keep, investing long term, et cetera. But if you're retired, or if your family that's retired and they need capital for the short term, that may be something to consider of not keeping all your cash in the market, just in case it drops. You don't have to take a hit and then have to withdraw funds. Trade policies, President Trump's imposition of a 25% tariff on steel and aluminum. It's heightened global tensions. It's impacting commodity prices and market stability. So very unstable part. What's going to happen there? I think they're trying to negotiate again with these tariffs, steel and aluminum. How it's going to play out, we don't know, but that's causing a bit of unrest. Global events, ceasefires in conflict zones. So this is actually, I think, is going to bring stability. With this is the Ukraine war with Russia, and they're trying to end the war. Everyone really at this point is trying to end it. However, uh, there's really negotiations that need to happen, right? Russia still occupies, I think, 20% of Ukraine, and then Ukraine occupies probably less than 1% of Russia in the Kursk region, and they're trying to come to an agreement where, the war can end peacefully, Ukraine can be at peace, govern themselves, and then I don't know what's going to happen with the land. So stay tuned for that. But once that's over, I mean, now we don't have a war I mean, there's other wars in Africa, but we don't have a war in Europe going on that is really unstable. It's really risky, can cause, a lot of, nuclear power, nuclear war possibly in a worst case scenario. But more than anything, it's impacting trade. People are not trading with Russia because of the situation. That's increasing prices in oil, increasing prices in commodity. So that stabilizes thing. It's a positive thing. Let's see how if it works out that way. As long as Ukraine is able to get a fair shake on it as well, then just anything happening there. So that's a quick little market update, and then I'll leave it for the next one. If you've been with us before, I kind of do some in-depth, but I wanted just to bring some key points here. So now here is a word from our sponsor. And if, are you looking to buy or purchase a home? You're looking to become a homeowner, looking to become an investor. We at Coso Capital, yep, that's us, can help you get the financing you need. If you don't have a realtor, we can connect you with a realtor in your area. Or if you already have one, we partner with them to make homeownership happen. I'm passionate about it, and that's what we do. So whether it's a home, investment property, business, or equipment, you need financing, give us a shout. We would love to help you. Contact me at denny@cosocap.com, residential or commercial. That's denny@cosocap.com, NMLS 388985. And realtors that are listening, we're always looking to build our realtor relationships. Are you interested in learning how to invest in real estate? If you want to get access to short reports, how, top 10 tips, how to get started, send me an email, put investing on the subject line. I'll get that information to you. And as we roll out courses, live seminars, more things happening, you'll be able to be on that top of the list. So denny@cosocap.com. All right. Now we're headed to, there's an article I just read, and let me grab some water before I pass out. It's from the Wall Street Journal. It says we're headed toward our landlord-friendly era. Expect higher rent prices. And now what I'm going to do is I'm going to share my screen if I can make this happen. Let's see. See if I can share my screen. I've never done this before, but bear with me. And let's see here. Let's see, share my screen, share. How we doing? Boom, can you see that? All right. First time, excited. All right, so we're headed toward a landlord-friendly era. Expect higher rent prices. The prospect of rising apartment rents could further stoke inflation and give the Federal Reserve another reason to pause. So when they're talking about pausing, they're talking about interest rates, right? So it says if rents go up, then that means inflation is going up, and that means interest rates need to go slow, right? So let's talk a little bit about the article. This is from Rebecca Picciotto. Hope I didn't butcher her last name. 2023 to 2024, after COVID, rents skyrocketed, right? Now that created a lot of developers and investors said, hey, we need to build apartments. Rents are going up a lot. We can get a great return on this. There were a lot of in the pipeline, and then said, let's get it off the ground. Now, what ended up happening is supply and demand, right? So rents went up, apartments were built, rents went down, all right? So the rents went down. Now, mortgage rates then went up. And prices, so mortgage rates went up, and the prices of homes also went up at the same time. So it was really hard to become a homeowner, right? So like these are all things happening. So more renters, right? Now, fast forward to now, new construction started draining. It started slowing down. and by the year end of 2024. And that basically started causing problems because now there's still the population of the United States is growing, right? So we expect to have, I think by 2050 or 2075, it's like 400 million people. We have 330 million people. So we need more housing, especially in major cities, metropolitan areas where people want to live and the suburbs around it. And construction started slowing down. So it started flipping from renter friendly to landlord friendly. And that's like we're in the situation now. So ended up last year, it was really renter friendly. Rent had gone down. Landlords couldn't rent space. Now it's starting to shift because no more apartments aren't being built as much in major metropolitan areas. And it's creating a lot of demand from renters. So rents are starting to go up again. And it says shelter is 1/3 of the consumer price index. So that's why it's affecting inflation. And I mean, it's always been doing that. And I don't know, and I'm going to kind of hit on a point on the politicians here. What should they be doing? Some parts of the country rents are still increasing in the Midwest, Northeast, parts of the West Coast. Um, for example, it says end of the year positive rent growth throughout the country is expected. So in some places where there hasn't been a lot of construction, where rents were maybe too low to build, because building costs a lot of money, right? In certain places, it can cost 200, 300, $400,000 to build one unit, right, of construction of like apartments. So that's why it's hard to build them. And then and this can be either because of zoning costs, it can be because of construction costs, it can be because of material costs, right? And then add in certain areas, it takes longer to build. So you have to hold the land, you have to pay for the land, and while you're carrying it, all that. Now, in 2024, 518,000 new apartments were delivered. So that's like kind of the highest that has been delivered in I don't even know how many years. But in 2025, it's going down to 440,000. In 2026, it's going to be around 331,000 and this about the same thing in 2027. We should be thinking about that it should stay consistent or go up, right? Because the population is going up, right? So that means the amount of apartments that are coming should be going up. But that's not what's happening. It actually has slowed down and that is affecting the price of rent, economics, supply and demand. It, Another point is the new president's policies may slow the pace of construction even further because of migrant deportations and higher costs of materials through tariffs. So interesting points here. 25%, so 1 out of 4 building materials comes from Canada and Mexico that comes to the United States. And undocumented workers, so the people that don't have citizenship residency, they're about 13% of the construction workforce, right? So about 13% of people don't have legal status, are the ones building a lot of the properties. So it's not actually, I thought it would have been higher, but it's actually not that high. But that's going to have an effect, right? Because then now there's going to be less people to do it. So it may not have a huge effect, but imagine if it's dollar for dollar, like 10% extra in construction. When you're building $440,000 unit, now it costs you 440,000, right? So as if you're building an apartment building, if it was 400,000, now it's 440 because now construction costs went up by 10% because now you lost those people. And you also have those more expensive materials. Vacancies are starting to go below the average in some places. 5% is normal. So whenever, let's say you own an apartment complex and there's a normal vacancy rate, people move out, right? They move to a different state, they move to a different city, they change jobs, they buy a home, they move out, right? People pass away, all that. Now, 5% is the average vacancy that the property stays empty during this term. But now it's actually gone down. I don't know what it didn't say exactly, but could be 3, could be 4%, that it's below the normal average. Tenants in a heated battle for vacant space, 9 renters for every apartment in some markets. I'll give you an example. This is Amber Melhouse in Brooklyn, New York. She was paying $4,250 in rent, and then her landlord increased her rent to $5,600. After 60 inquiries, 60, and finding nothing better, She decided to stay and rent out a spare room. She stayed in the apartment, paid the higher rent, rented out a spare room for extra income. She's a small business owner. She says she's frustrated with the situation. I don't know, it didn't really talk about it, but why isn't she thinking about home ownership? I know Brooklyn, New York City is a hard place. It's a more expensive market for home ownership. But if you're not in one of those markets, you really should be thinking about how can you own a home where your payment can be fixed. It's shifting, right? It's going to be more challenging to be even a renter now, right? So make sure that you're putting yourself in a position so you can become a homeowner, even if it's in 3 years, 5 years, 10 years. Give me a shout. Let's set up a plan. Higher rents could increase pressure on government officials who campaign on pledges to lower housing costs. This is actually a positive, some hopeful event. Example, YIMBY. Yes, in my backyard. So there's something that goes around, no, in my backyard. A lot of people don't want new construction in their area, apartments, sometimes even houses. They don't want anything. Don't build anything. But this is another uh, belief that's kind of coming around, another group. It's called YIMBY. It says, yes, in my backyard. And this is a bipartisan caucus. So these are Democrats and Republicans. And then the spokesperson here was Rep. Robert Garcia of California, where he's looking to create legislation to boost housing supply. That's a positive. So kind of giving you my take. Look, housing is the most expensive item that's increasing inflation and that is affecting people's pockets. I mean, imagine if you make $1,000 and you have to pay $500 in rent, or if you make 2,000, you have to pay 1,000. That's 50% of your income, right? What if they can get that reduced to about 500, 600, $700? If you're, that's 30% of your income. Now it's more manageable to live. Even if groceries go up, it doesn't, you can manage that because your housing isn't so expensive. That's the key about home ownership in the United States. We have a 30-year mortgage, probably one of the biggest benefits that the United States provides. It's this loan that stays fixed for 30 years. It doesn't go up. So you can get it locked in and you can just have a fixed payment for 30 years. It's a long time, and now you don't have that stress, et cetera. So the government should really be focused on creating programs for that to be able to get people to uh, become homeowners. Down payment assistance programs are great ways. The community land trusts are another way. That's another comment for another day. But then also for renters, it's finding ways for middle income renters to be able to get some of these tax credit properties and have fixed rental payments where they're going to subsidize it really at the end, because how can people afford $5,000 a month in rent, right? It's just getting out of control. All right, so we'll leave it there. And let's finish up with some of the past books that I've read, but let's have a word from our sponsor first. So if you'd like to send in topic ideas, questions, or examples, the let me, if you'd like to send topics, ideas, questions, examples, you can send them to denny@cosocap.com and we will go over them on the show. What you're doing with your finances, what are you doing for investing, things that you'd like me to cover, denny@cosocap.com. And then this one's for investors. Do you have capital and do you want to diversify your investments with real estate? I'm a landlord. I do own investment property. I've worked with investors before. We hire, at Coso Cap, we provide opportunities to partner with us on our real estate projects or lend directly to borrowers flipping houses. So also we lend money and it can be your funds lent to people that are flipping houses. An attorney, they do the mortgage, they do all the paperwork, and then you have the mortgage, they pay you directly your interest payments. And then we are basically the originator in the process there. All right. So these different options, depending what you're looking for, either you want to invest with us in a project or you want to lend your own money forward, we can help you. As with any investment, risk are involved and losses are possible, right? Because it's an investment. However, one reason I favor real estate is the security of the collateral. So you actually either own part of the building or you have a mortgage on the building. You can get your money back if they don't pay you. You just take the house. You own part. You have a mortgage. So since 2010, it's when I started investing. We've been flipping homes. By 2015, we expanded to apartment buildings. I say we, it's me and my wife, Desiree. And today we focus on developing houses. So we have a really large 35-acre development. We're not even sure if we're going to allow investors in, but we want to have a list because you never know. And It's to build houses, townhomes, and multifamily properties. It's about 417 units. And over the years, we've partnered with investors to acquire several million dollars in real estate. To ensure compliance and transparency, all documents are prepared by a securities attorney, and we provide monthly reports to keep you informed about your investments performance. If you're interested in learning more, email us at denny@cosocap.com. That's denny@cosocap.com. You can do a cup of coffee, Zoom call, and then kind of see if it's a fit. If you have, you have the experience, you have uh, the desire to invest with us, but also for us, to make sure that we're a good fit to work together, right? Because this is like a 3 to 5 year investment. If you're investing with us, or if you're lending, it's typically about 6 to 12 months if you're lending for people. All right, so now let's talk about some investment tips. And as I mentioned in a previous episode, I talked about how we used to be a property managers of our own properties, and then we handed it off and we just took over again. Kind of been on this there, had a third party managed, had a third party, now we're managing again. And really, at the end of the day, no one's going to manage the property like you are. And if you have a smaller properties, when I say smaller, multifamily, anything under 50 units, under 100 and 150 units even, where you can't have employees on site that are operating it, it's hard to find a great manager because most of the managers that you find are real estate brokerages that typically manage houses. They're not used to managing these larger multifamily properties. So then you kind of get a hybrid approach, and really it's very difficult to make that work. Uh, we had a manager that we just got rid of. We ended the relationship, and part of the reason was there were several things. Number one, several units got vacant at a time, right? Stuff started falling through the cracks. So there was a unit that didn't even get inspected for like a month and a half. And then on top of that, when I asked questions to the owner and I'm like, hey, what's going on here? The person basically asked for more money instead of trying to resolve the problem. And not that people can't get paid more money, right? Renegotiate things. But at the end of the day, I think the approach that she took wasn't, hey, I'm going to resolve this. And then it was more of like, hey, we're not getting paid enough to manage the property. So once I saw that, I'm like, okay, we probably need to see about considering hiring somebody else. And that's why I put an ad out. We found an employee. We have them in the process of transitioning everything, and we just took over the beginning of February. Now, here are some tips. If you are hiring a third-party property manager, let's say you have a house, let's say you have a few houses, what should you do? How do you protect yourself? Well, number one, the first thing you want to read the lease that they're going to be using for your tenants. Maybe you have your own lease. I would really recommend that. But if you don't, read the lease that they're going to be using. What is in there? Are they charging any fees to people? Make sure that there's no fees that they're charging to residents, like repair fees, stuff like that. Anything that's not disclosed, have that clear and upfront. Because if they start charging repair fees, then people may not call for repairs, right? Because they don't want to pay any fees. So it's kind of like incentives. Then number two, make sure that you're signing every lease, right? At the beginning, you don't want to just hand everything off to them. Have them send you the lease, you review it, you sign it, make sure it's in line with the price you said, security deposit, everything that you said. That way, if something happens, the lease is the way you want it, right? That's easier when you have less units. When you have more units, it's more difficult to do that. But at the minimum, I think if you hand off signing ability, you definitely need to start auditing leases after the fact, getting the leases after it's signed, and then you need to review them. And if you're busy, because I know we're all busy, you need to audit them. So you pick a sample, maybe every 5 leases, you take 2 of them and you read through them, you audit them, and then you verify, make sure it's correct and aligned and everything. Another tip is to review the renewal. So you look at your rent roll. The rent roll is all the rental units and then everybody that lives there. And it should be accurate. And it should say when leases expire. And you need a plan for when those leases expire, what's going to happen? When are they going to get a renewal lease? At what rate they're going to be renewing, if they are going to be renewing. So it's try to take control over these things. Don't just do it hands off with the third party property manager. Really, they're managing so many units, stuff is going to fall through the cracks. If you have a good property manager, hold on to them because they're a really rare breed. just like in any business. Uh, but really focus on you staying on top of them to make sure things get done your way. And what's this? What's the real main secret of this? Is that really there is no such thing as completely passive income. You always have to stay on top of your business to make sure that things are operating correctly. Once you have more units and more scale, then you can hire help to help you get less, get out of the weeds with all these little things that I call minutiae. But they're important because, if you start adding up leases with challenges, it could really affect revenue. It could affect then expenses and the quality of your property. So hopefully that was helpful. All right, so now let's get to books. So I read a few books, and the first one I read is something called Technopoly, and it was interesting book. It's a little dated because I think it's like from the 90s or 80s. But here's a few notes from it, right? So the main idea is technology isn't a tool. It reshapes society, values, and even how we think. We assume progress, and in fact, let me go ahead and make sure that I share. Oh, let's see here. Let's see here. Share. There we go. We can share that again. Oh man, stop sharing. Okay. Let's see. Man, I had it right the first time, and then there we go. Here we go. Okay, here we go. I got it. All right. So here we go. Technopoly. All right. So Technopoly, so technological determinism, who's in control? We like to think we control technology, but in reality, it shapes our culture, priorities, and even decision making. Every major breakthrough, the printing press, electricity, the internet reshaped authority and societal norms, right? So technology really becomes, it's created by humans, and then it shapes who we are as humans, right? Throughout life. Think about the internet. How do we live now with email and social media? Example, before modern technology, knowledge was shaped by culture and philosophy. Today, we rely almost entirely on data and science. Number two main point was information overload. More data equals less understanding, right? Because it's just more confusing. We have so many pieces of data, and it's easy to challenge it, right? We have endless access to knowledge, but does that make us more insightful? Specialization has created experts who know more about less, but often miss the bigger picture. So they're not getting the context sometimes of about the whole picture. You got to get a lot of experts together so they can understand what's going on because it's just so confusing. For example, Copernicus, the father of modern astronomy, who I don't know if you heard of Copernicus, who in around 1500, he's the one that said the Earth revolves around the sun instead of the sun revolves around the Earth. I don't know how he did this in 1500, but it's amazing. He actually didn't. He only had an IQ of 100 to 110, right, which is about average. He wasn't a genius. Proving intelligence isn't just about raw ability; it's about exposure. It's about thinking frameworks and education. So that's what we need, right? As humans, we need exposure, we need thinking frameworks, different ways to think, and of course, education. What defines an educated person, right? That's a good one. Before mass entertainment, exposure to art, literature, and philosophy was considered essential for education. Past generations engaged with Mozart, Beethoven, Shakespeare, and Whitman. Now social media dictates cultural literacy, right? So whatever happens on social media is what's in. If technology shapes how we think, are we becoming better thinkers or just better consumers? Hmm. Something to think about. Are we in control of technology or is it controlling us? Interesting. I liked it. Kind of bring it up to speed of, hey, am I being controlled by technology? That's why it's a good time also to disconnect, be alone with your own thoughts, and then that way you can just really be yourself instead of letting yourself be influenced by all these things that are hitting you. So I've been trying to do that, walking, and it's awesome. All right, now let's go with the next one here. The Bold Supremacy. Been wanting to read this one for a while, right? I'm a big fan of Usain Bolt, sprinter. I actually sprinted in middle school, ran track, and got a silver medal when I was in seventh grade, which is really cool for the county track meet. And so after that, I wasn't the fastest guy, so no more sprinting. But interesting book. Its main points is Jamaica's sprinting dominance isn't about genetics. It's a mix of culture, training, psychology, and accountability. Culture and training was a main thing that was highlighted in the book, sprinting as a national identity. So it's part of Jamaica's DNA, right? Sprinting. And they reward it, they promote it, they're excited about it. And they talked about like you would go to the events and there would be, young kids ready to, you know, big, large events, well attended. In Jamaica, sprinting is just a sport, it's a way of life from young kids. Kids race at school events like champs, the most intense high school track competition in the world. That's in Jamaica. So think about it, right? Like they call it like an agglomeration of kind of all these fast people keep living in a certain place, and everybody there becomes faster and faster because you just kind of get that development. The country has only 3 million people, yet it produces more elite sprinters than 300 million people in the United States, right? So something there, something in the water, as they say. Shelly Ann Fraser Price is another example of how Jamaica consistently develops world-class talent. And I think with Shelly Ann Fraser, she was also in this last Olympics, really fast girl. I'm not sure if she won or not, but one thing that was interesting, she was competing with the previous gold medalist or previous top sprinter of Jamaica, and she beat her in Jamaica. And one thing that they wanted to do is they wanted her to step down and let the other sprinter run in the Olympics because Shelly Ann Fraser was an unknown, a younger girl at the time too. I think maybe in her teens. And she, of course, she said no. But interesting enough how that kind of matriarchal thing came about. Coaching and development, nurturing talent through accountability. Usain Bolt's father held him accountable, ensuring he trained and stayed disciplined. Bolt wasn't just talented, he was coachable and trusted his trainers, like Glenn Mills, who refined his technique. They talk a little bit about Usain Bolt. It wasn't all about him. It kind of went in different sprinters and talked about a little bit of the culture and went throughout the book. But it did talk about, he was a kid, he was young, he was a bit uh, rebellish, right? But at the end of the day, he was very disciplined to do what he needed to do. So he definitely earned what he got. He trained significantly. Younger athletes succeed because they see role models ahead of them and are raised in sprint-focused systems. And then the last point is psychological edge and the science of sprinting. Skill in sprinting isn't natural. It's built through practice and refinement. So it's over time. It's through a lot of practice and refinement. But one thing that they had throughout the book that was going, they had doping concerns kind of being raised, but the author could never really pinpoint and say, hey, this evidence was here and you're guilty, right? They caught him red-handed. But they were also kind of sharing stories where they would fire people that were doing the strict tests for the doping and all these things. So it kind of left you with that idea of, is that a problem? And I think that's a problem globally, right? Doping is a problem globally. It's not in just Jamaica. It could be all over the world. So I think even if it's there, people do it here and they're still winning, right? So it's kind of, I think at some point they should all just stop doping because if everyone is doping, you're getting the same results, right? It's like equal. Uh, so it didn't really say that they're doping, but it kind of gave you that could be one of the concerns, but never about Usain Bolt. It just said some that could be happening in the background with certain sprinters. A surprising study, the more older brothers a person has, the higher the likelihood of some homosexuality that was mentioned there in the book, which I think was a bit random, but it was interesting, showing how biology interacts with environment in unexpected ways. So is speed born or built, right? Jamaica's sprinting success story shows why raw talent isn't enough. It takes discipline, coaching, and culture obsessed with winning. I mean, I think you definitely have to have that talent, but then you need to harness that talent. You need to develop it. You need to be around the right people. You need to be around the right culture to really get to that world-class level. Can you become Usain Bolt if you're just really talented? Not necessarily, but I think you can definitely become a better sprinter if you're training with the people that are in Jamaica. So that's interesting. Let's go with this next one. This one is insanely simple. I actually probably could do a whole episode on this book. And I really like, it's an engineer. He worked with Steve Jobs. I believe he worked on the iPhone and several other products. And he kind of talked about his experiences with Steve Jobs. So I'm a big fan of Steve Jobs and his achievements. and with Apple for his innovation, of course, his management style, not necessarily attractive, but always looking to learn anything that I could learn from anyone, right? Even if, the certain things that they had that I don't like, but I try to learn from the good stuff. And he had a lot of good things. And it says Apple's success wasn't about complexity. It was about an obsession with simplicity in product design, marketing, and leadership. What a lesson, right? Simplify, simplify, simplify. I kind of get stuck in complicating things. The podcast, the social media, being by myself, you kind of have so many ideas. So that's what I'm working on now. Is trying to simplify, right? Kind of got that from that book. Steve Jobs built a culture where brutal honesty, high standards, and clarity drove innovation. So that's something actually that was good. I think the way he did it was the wrong way to do it, but I believe in the idea of what he was trying to do. He was trying to achieve really great things for customers, but I think it's just his approach. I just think could have been just so much more impactful. But he got the results, so it worked for him. I'm not sure it worked for everybody, but it worked for him. So some main points, the power of the simple stick. I like this one. Cutting through complexity. Simplicity isn't passive. It's a discipline that must be practiced daily. Apple had money and resources, but their real edge was clarity, knowing exactly what mattered. One product, one box mindset. Focus on the essentials, eliminate distractions. Simplicity kills bureaucracy. No committees, no over-engineered processes. The next one is high standards, no compromises, the Apple culture. Brutal honesty without being brutal. Jobs would say, don't show me shit work, don't do it again. Apple managers were ruthless enforcers of high standards. Only submit work you believe in 100%. Meetings were small and essential. If you weren't necessary, you got thrown out to do something productive. So there were like people sometimes in meetings, and it's like, oh, hey, this person's in this meeting, and Steve Jobs was there. He's like, oh yeah, we don't need you to be here. You can go. Oh no, but this person told me, yeah, yeah, but that's fine. Take off. Because they don't want anybody else in there that maybe can distract the situation or can add or subtract or anything else. They wanted things as simple as possible. Uh, Apple managers, it says, oh, no big company behavior. Run a $1 trillion business like a startup. Run a $1 trillion business like a startup. It comes kind of from the Amazon mentality too. So this kind of things are consistent with high achievers like Jeff Bezos and Steve Jobs. Number three, marketing and brand simplicity. Emotion over features. Ads weren't about devices. They were about emotions. So make sure that you harness emotions in your ads. Example, 1,000 songs in your pocket instead of a 45 gigabyte music player, right? What's sexier? 1,000 songs in your pocket. Apple's favorite medium, outdoor advertising, right? Who would have thought? Outdoor advertising. Short, powerful, and image driven. Think Different wasn't just a campaign. If you haven't seen the Think Different, look it up on YouTube. It's a great video, but also it was a campaign. It was Apple's DNA. This is what they were about. Apple didn't just sell products, they sold desire. Oof, that's just really defined what they do. Simplicity wasn't a strategy, it was their entire philosophy. What if your business did the same? What if your business did the same? A lot of lessons in that book. Highly recommend you read that one. Highly recommend it. All right. Oh man, and I didn't move on. This was the book here, Insanely Simple, Succession. All right, this last one. Okay, What Works on Wall Street. This is a bit of a technical book. Don't want to get too deep into it. It's about the stock market. What Works on Wall Street, a guide to the best performing investment strategies of all time. If you're a stock market junkie, you're gonna love it. Investing, make sure to be careful, right? Investing is risky, but the stock market isn't about gut feelings. It's about patterns, data, and discipline. The best investors don't guess. They follow proven, back-tested strategies that stand the test of time. Rules beat instincts. So have rules, and this is the rules that I live by for my investing and respect them. The power of data-driven investing says gut feelings don't make money. So don't have gut feelings. Quantitative strategies do. Back testing shows that certain investing formulas consistently outperform over decades. And that's what you really need to achieve great returns. You need decades long high rates of return. Example, they talked about the dogs of the Dow strategy, which is buying the 10 highest yielding Dow stocks and rebalancing annually. That has historically beaten the S&P 500. That's something you need to do your research before that. If you like some of these strategies and you want to implement them in your business, you need to research that strategy for the last 10, 15, 20, 30 years and see how it worked out before you implement it, because it can be very risky if you don't. Just basing it off of a book without you doing your own research. Key factors for winning investments: low price to sales ratio. Stocks with a lower price to sales ratio tend to perform better over time. High dividend yield. Large companies with strong dividends offer stability and compounding returns. Sharp ratio measures risk-adjusted returns, higher sharp, better strategy over time. So these are some factors that you're like, hey, look, let me check, let me see. I'm trying to look through these lists of hundreds of thousands of stocks. How can I narrow it down? Well, narrow it down using this, and then you can look and see these companies, how they're doing, and kind of dig deeper. I'm a Buffett Munger guy for investing in the stock market, but you can definitely pick up tips from a lot of other places. Consistency wins. Stick to your strategy. Markets revert to historical averages. I believe that. Reversion to the mean. Fear and greed create short-term noise. So remember, be a long-termer, 5 years or more. Best investors stay disciplined. Changing strategies constantly is a recipe for failure. James O'Shaughnessy's research: long-term systems outperform stock picking gurus. So be careful with that, the stock picking gurus. Want to beat the market? Stop following trends and start following data. The numbers don't lie. I like it. Well said. All right, and then the last one. This one is The Crux by Richard Ramel. And this was really a nice gem. I don't know if you know Richard Ramel. He wrote Good Strategy, Bad Strategy, and he believe he's a professor at Stanford, I think, or UCLA, one of those schools in California. And he writes about strategy. And I'm a fan of strategy as an entrepreneur, and I wanted to, pick up some good nuggets on it. And I read Good Bad Strategy. I thought it was okay. I just kind of felt like it didn't really provide like the meat and potatoes. It had a few little nuggets, but not anything big. But I thought The Crux, I really found a lot of useful information. And this one it says, main idea is strategy isn't about a vague mission statement or setting arbitrary goals. It's about identifying the biggest challenge and taking focused, effective action to solve it. So finding what's holding us up, what's the biggest thing we need, and how can we fix that problem so we can get things going and running the right way. Finding the crux, solve the right problems. You can't fix a failing school unless you first understand why it's failing. Ryanair strategy: play games you can win. Focus on profitable routes, not competing head on with larger airlines. Imagine Ryanair competing against British Airways back then. Winning strategies: focus on one or a few key problems, not everything at once. It's advice, really good advice. One thing at a time. Action over theory. Strategy is doing. iPhone had no market research. Apple took action based on expertise, not surveys. So be careful with market surveys, and then create the product, put it in people's hands, and let people tell you what they think about it. And let's see if they're going to use it. That's something that I really like also from one of the books on Apple, that they would create it, they would test it out, and they would see if people were interested in it or not. And they would kind of keep changing and keep evolving. A good strategy aligns actions. Every move should reinforce, not conflict with the overall plan. Goals without analysis are meaningless. Good objectives come with clear actions and KPIs. KPIs, I think that's keys. I can't remember. Brain fart. So simplify and focus. Prioritize your right moves. Pick your battles. Private companies buying other firms. Use cash, not stock, to stay in control. 3 priorities max. If everything is important, nothing is. Senior executives should commit to a few high impact goals. They shouldn't try to do 10 goals or 20, or because it's just too much. Forget long mission statements and use models instead. Just do it. Think different. Semper Fi. Strategy isn't about having a goal. It's about knowing exactly what stands in the way and taking action to fix it. All right. So let's stop that share. And I hope that you got a lot out of that with the episode. Please subscribe, like if you haven't yet. And for the algorithm, write a comment. Hey, Danny, I really like this. I like that. Or and share it. Share it with your 5 friends, 10 friends. To help us grow the show and grow the channel. Well, until then, see you guys next time. Thanks for being with us. All right. Bye bye.